Stock exchanges are not just places to list companies. They exist to discipline them, to enforce standards that protect every investor. First Gen's recent clarification about its agreements with Prime Infra should concern anyone who cares about Philippine capital markets. The company has confirmed contractual provisions that could trigger forced sales of its hydropower stake at a steep 25% discount, worth roughly 15.5 billion pesos. If exercised, further discounts on its gas assets could reach another 8 billion pesos. These figures are not speculation. They are quantified losses publicly admitted and potentially massive for shareholders. The economic risks are directly tied to changes in management control, specifically to whether Federico Lopez remains at the helm. First Gen listed 6 distinct triggers, all connected to his position or those of his designees. The financial stability of strategic assets depends not just on business performance, but on the continued dominance of particular individuals. Governance here is not abstract. It is financially material. Did investors have full, fair, and timely access to information about these governance-linked risks? PSE rules require that any material development must be promptly and clearly disclosed. The fact that this risk can now be precisely quantified raises a critical question. When did it become significant enough to warrant disclosure? And was the market informed accordingly? Too often in Philippine corporate life, governance is treated as cosmetic, but real governance constrains actions, especially in times of stress, when shareholders' interests may diverge. Public shareholders deserve clear answers. How was the clause approved? Were independent directors fully informed? Why was disclosure not immediate and comprehensive? Small shareholders stand to lose the most from opacity. Controlling families and strategic partners often have access to insider channels. The public's only safeguard is the integrity of disclosure. This is why investor protection and transparency are enshrined in state policy, and why the PSE must ensure all investors get equal access to material information. Regulators must set a higher standard for governance-linked clauses. Comprehensive supplemental disclosure should be mandatory. Trading halts may be necessary to prevent markets from operating on incomplete facts. Penalties for lapses must be serious, not symbolic. Foreign institutions track governance closely because their capital is at stake. First Gen already counts a major foreign shareholder. If governance-linked risks are left murky, minority capital in emerging markets burns easily, and trust erodes. First Gen deserves a fair hearing. Their defenses matter. Yet the governance issue is larger than any explanation. It defines the terrain for future scrutiny. If governance can move billions, it must be disclosed as if billions truly depend on it. Market integrity hinges on this principle. Only through accountability and stronger practices can both domestic and foreign investors feel their capital is genuinely protected. The lesson is simple. Transparency on governance risks is not negotiable because the stakes are real and the consequences material.